Hey, it's Ryan from the Option Income Advisor, and this is the trade of the day for July 6, 2021. And we actually have a couple trades coming out today because of the long weekend. And this is kind of on the back of a video that we put out last week, in an article that we put out on Seeking Alpha about kind of screening for the best dividend stocks for our option income strategy, the triple income wheel. And so, that article kind of highlighted, some high level filters and stuff we use to find good dividend stocks. And so the next couple weeks, as we do our trade of the days, we are going to highlight dividend stocks specifically. And so the next, call it 10 trade of the days, will be focused on the dividend stocks that we found from that list. And so I'm gonna kick it off. We're gonna look at Caterpillar today. So Caterpillar is our trade of the day. We're gonna look at today, and you can see it was up a little bit last week, but it has been selling off a little bit. We're off. What are we off? About 12% from the recent high. And you can kind of see from the rankings and some of the cyclical stuff that we've been doing the last few weeks. You can tell that the rankings, kind of safety and value, were off quite a bit, just with the pandemic and with earnings and sales with those businesses. They really took a hit. And so with these dividend stocks, they're more higher quality, blue chip stocks, good operations, good balance sheets, things like that. And so we're going to see a lot of above average, not only dividend rankings, but safety and value as well. And so Caterpillar kind of falls, into that bucket. You can see they're all the main rankings are all kind of in the 5 and above, so they're kind of average or above average on all the rankings, and we can go into that a little bit. But our strike zone that we're going to be looking for is 185 to 202, which represents about a 7.3% margin of safety below the current price. And so factors affecting the margin of safety, we've got volatility and risk. And pullback, and so those are kind of the two main ones that factor into that. And again, that's taken into account the specific volatility of this stock. And again, it ranks a 7, which is out of 10, so it's actually on the higher end, which is good. Not higher end of volatility, but higher end of our ranking, which means it's a positive factor in it. And then we've got pullback indicator again. This is not a very volatile stock. It's mean implied volatility is only about 24%. And so the fact that it's already pulled back 12% kind of gives you that, comfort that it's already had a decent pullback for a stock like this. And so you've got that kind of factored in here as well. And so those are things that kind of, again, factor into how much margin of safety do we really need here. When we're looking at a cash secured put, and then something to keep our eye on. We do have earnings within 28 days, so that's something we need to look at when we look at our analysis down below. And again, CAT, very liquid. It's got the ranking of 10 for liquidity, which is the best we have. So that means the options are going to be very liquid as we go through and look at that. So let me get rid of this, and we'll take a quick look at the chart. So the chart, looks like it took away my moving average there when I got rid of it, but it's here. So I'll talk about it on this smaller scale. But I mean, the only thing I want to point out on this chart is that the 200-day moving average is the stock's been well above the 200-day moving average and moving higher, and the trend's higher. But you can kind of see it's kind of starting to come down towards it. Well, the moving average is right at about 200 right now. And so we know from just looking at our strike zone. So that's right in our strike zone. So the 200 level is right in our strike zone. It's the 200-day moving average, which is kind of a major long-term moving average. So you've got this conversion point there where you've got the moving average, you've got this kind of psychological round number of 200 that just tends to hold whenever whenever stocks pull back. Big numbers like that tend to hold, and it's also in our strike zone. So that level looks very good to me when I think about a level where I'd write a put. So certainly in the short term. So that's something we'll look at when we get down below here. Just valuation and some of this stuff with these cyclical stocks. A couple things to point out. Obviously we've come quite a bit back from the pandemic, right? A lot of these stocks are getting close to where they were in 2009, kind of pre-pandemic, and that's Cat's definitely in that boat. And so, I mean, you can see where they were in 2020, and then I think this is about an 80% increase in earnings just in 2021, and they're expecting another like 20%. I think their 2022 numbers up over $12 a share. So, there's certainly tailwinds and momentum, coming, our way here with this stock. So, I think, again, the next couple years, that's kind of where we're kind of neutral to bullish on the stock in general, because we've got some tailwinds with earnings. So the question is, when are those earnings going to start to be repriced? At some point, they will be. If interest rates rise and we get some worries about the economy slowing down, a company like this will certainly take a hit. But again, historically, this stock is not a volatile stock. It's a pretty good blue chip dividend stock, and even though it's had a big run, it was down quite a bit. And so that's our thesis with this stock now, right? It's are we going to be in this situation where maybe we have a tailwind for the next 12 months, and we're able to write puts on this stock and churn out a 10-12%, maybe even more on the income side without overrunning the stock, keeping that margin of safety in there. And for this stock, it could be in the 7-8% range margin of safety. So we'll have some flexibility with the price moving around, but we'll be able to earn, what is that, about 4 times what the dividend would be with this stock. So let's take a look now at the put analysis. So remember, we're focusing on the August numbers right now, and so I'm looking at these 8/20 August 20 numbers right here. Okay, so you can see the EPS risk is there. We know we're reporting in 28 days, so that means the EPS risk is within the time frame of this option. And so, we look at average monthly yield and delta as our big numbers, right? And so for kind of our base strategy, where we're looking for 1% per month, kind of between 1 and 1.5%, we like to have a delta below 30 when we're going out this far. And again, just looking at this column here, all of them have EPS risk. We're looking for options in the strike zone, certainly for our base strategy. On the aggressive side, we'll go a little bit higher than that. But for the base and certainly the conservative strategy, we're looking for stocks or options that are in the strike zone, right? And so the strike zone is 185 to 202. So this 200 and this 195 are both in the strike zone. But kind of looking at where it stands today, we've got about 0.8% average monthly yield, and we've got an 8.2% margin of safety with a delta of 20. So I like that risk reward. I think, again, if you can get 0.8% consistently with this cash secured put wheel strategy, it's pretty good for a stock like this with a volatility of 24. And so if we can get, again, that 0.8% per month, we roll over, every time this expires, we either roll over or, if we get assigned the stock, we'll sell a covered call. But, again, that's the whole wheel strategy, right? If we can keep the wheel moving, there's real potential here to earn some serious income, over and above what you'd get, just investing in the stock, because the dividend yield here is about 2%. And so what we like about it though is it's a blue chip stock. If we did get filled at 200, we just looked at the chart. 200 seems like it's a decent level. It's got earnings tailwinds behind it. So it's a stock that I'd want to own, right? And so that's kind of part of the theory with this strategy is that, hey, it's a stock we want to own. It's a stock we're going to earn quite a bit of income on, and if we end up owning it, then we get to kick in that dividend and just keep the whole wheel strategy moving. So that's the one I would take for the base strategy right now. And again, it's there because there's $10 increments here. Unfortunately, this for the aggressive side, and again, this is not a volatile stock. So when you go up to 210, you're only getting 1.6 average monthly yield, which is fine. It's still within the realm of the aggressive parameters, but you only got about a 3.6% margin of safety, and then you've got a delta over 30, the 34 range. So that's where I would go on the aggressive side. But again, I would obviously prefer to stick with the 200 on this one. But if you're going a little more aggressive, you could go after that one. And then on the conservative side, being below 200, I think is a great price for CAT right now. And so being able to go below 100 or below 200 at 195, I think is pretty good. And the 0.6 is right in our wheelhouse for the conservative side. A nice 10.5 margin of safety, and then a delta at 15. So those are our three trades for CAT. Again, we're gonna be doing again our trades of the day are gonna be these dividend stocks for this series we're doing with Seeking Alpha. So go over there and check out the articles, and let us know if you have any questions. Take care.